Thank you, Adam, for your analysis of the travel industry and the road ahead. Decisions made without information are mere guesses. When you invest in a hotel, you do your research. You look at similar market segments in the general area. You look at demand and demographics. Ultimately, it's about eliminating or minimizing uncertainty. You put a lot of thought into this multi-million-dollar investment because at the end of the day, you want to be confident that you're making the best choice. People want to make informed decisions about their businesses. But the pandemic continues to create great uncertainty in our industry. With so many variables at play, how can one account for the challenges posed by uncertainty? Our next panel specializes in data analysis, forecasting, and demystifying the countless number of unknowns plaguing the hotel industry during these difficult times. They'll provide us with valuable insights into what data can tell us about our industry before, during, and after the pandemic. Please join me in welcoming Jamie Lane, Senior Research Director of Econometric Advisors and CBRE Hotels Research, Amanda Hite, President and CEO of STR, Cindy Estis Green, CEO and co-founder of Kalibri Labs, and Christina Trauthwein, Editor-in-Chief of Hotel Business, who will be moderating the panel.
Hi, I'm Christina Trauthwein, Editor-in-Chief of Hotel Business, and here we are at the AAHOA convention, but this time in a virtual session. What a difference a year makes. But as it always is with the hospitality industry, we're in it together, and yes, AAHOA is strong. Data is everything, and what the data says is certainly top of mind for hoteliers, especially now during these challenging times. Our knowledgeable panel, CBRE's Jamie Lane, Kalibri Labs' Cindy Estes Green, and STR's Amanda Hite, will present current trends and forecasts for the hotel industry. So let's begin. Jamie, I'm going to start with you. July's numbers are out. Unemployment rate fell to 10.2%, and the U.S. added roughly 1.8 million jobs. How does the data look, especially as it relates to the hospitality industry, and what insights can you provide?
Great. Thank you, Christina. So there was some good and bad news in that jobs report. The good news to start is the biggest gains were again in the leisure and hospitality industry, which is now down just 25% compared to the levels we were at in February, which compares to 50% in April. So considerable gains there. And even while we saw increases in COVID cases. But the bad news is that the pace of growth has slowed. And while it's great that the jobs are returning to our industry, to restaurants, retail sales, we haven't yet seen a strong rebound in the core office using jobs like professional business services, financial activities, which are the businesses of many of the customers that we serve.
Okay. Before we kind of jump onto some other questions, either Cindy or Amanda, do you want to add anything to Jamie's comments?
Go ahead, Cindy.
We've seen, there was the initial growth spurt when things started up again, and we've definitely seen, I think, many industries, but certainly the hotel industry has seen a little bit of a slowdown, but it's unlikely to keep growing at the same pace all the time anyway. And I think with the COVID cases starting to spike in different parts of the country, I think it just had a muting effect on the growth pattern that we were seeing initially, as things started up again in June, especially.
Okay. Amanda?
I think the employment numbers, it's a similar story when you look at the demand. Things are coming back since, the middle of April. We've started to see jobs are coming back, demand is starting to come back, but obviously the pace of that growth is slower today than what we saw a month ago.
Right. Well, let's talk about demand. How is the pandemic impacting demand today?
So obviously, huge impact, negative impact. We were sort of hit the bottom the week of April 11th. We saw only 7 million room nights sold in the US. So today, for the week ending August 1st, we're at 17 million room nights sold in the week. So certainly there is improvement week over week, but the big gains that we were seeing the second half of April and the month of May, the pace has just started to slow down. So we are gaining week over week, just not as quickly as we had seen a month ago.
And I think part of that comes from, we had a spurt with like 4th of July and some other Memorial Day weekend. I mean, there were a few activities that inspired a little bit more activity. And now, it's still, our data is showing the same thing. The week of April 10th, we were down in occupancy 77%. We're still down, but it's 48%. That's pretty good growth. Rates were down 43% at the absolute bottom. They're still down, but it's 28%. And we're seeing, decent growth in some areas. So it's coming back. It's not going to be linear necessarily. There's probably going to be fits and starts. But, I think with this COVID cases, there's going to be some intermittent areas that are stalling. And, the COVID cases are in the areas where the occupancy started coming back a little better, the beach areas or the vacation areas, but then people were going there and there were more cases. So I just think that it's going to take time to come out of this period.
Right.
Yeah, I think to add to that, the real question mark for the industry is after Labor Day, because the demand is the leisure driven demand in those destination spots. So after Labor Day, when everyone goes back to school, whether that be in person or virtual, what happens to demand? Because there's not a lot of corporate demand. There aren't group meetings out there. And that really the after Labor Day is the big question mark for what will happen to demand.
Now, I was going to ask how recovery is going as some of the restrictions begin to lift, but, what are some of the things that need to happen? Like you said, the schools affect that, summer vacations affect that. Jamie?
Yeah, so in addition to the short-term impacts that and Cindy and Amanda are showing, and we're also looking at some of the longer-term impacts. How is demand going to recover once the pandemic isn't the issue? So obviously, there's major shifts happening out there, and in e-commerce, and we're all ordering way more on Amazon. On Office, we're all obviously working from home right now. And getting people back to the office is going to be a core piece around, do we start traveling for business and group meetings again? And while the impact to the office sector is sort of up for debate with us all working from home and more space needed per worker, but there's not much debate out there and there's going to be less people overall going into the office. And some surveys have shown up to a fifth of workers working from home permanently. And what does that mean for long-term for lodging demand? And sort of two camps out there and it could mean a major shift down or a major shift up. And if we're working from home, we need more reasons to get together. We need more group conventions. We need to go visit the home office and see our coworkers and stay in hotels from that. So, and right now I'm leading more towards the latter, that it's going to induce more demand, but that's a big point of uncertainty out there.
Yeah. Let's talk about the performance of markets and chain scales and the types, in terms of recovery. What are we seeing in different sectors and cities?
Well, the One of the things that I would say, besides everybody knowing that leisure business is growing, a really big difference in this recovery compared to 9/11 or 2009 is that leisure business used to go heavily in 9/11 and '09. It went heavily to the OTAs. What we're seeing is that it's now split between the brand loyalty member rate programs and the OTAs, which is a big change. And that's a really good thing because the business is so much more profitable. So from an owner's point of view, as an AAHOA member, the thing that's really good news for any AAHOA member is if that business now, which is about 40% of the demand, is split half and half that business is more than twice as profitable as the third-party business. So that's a good sign. The other thing we're seeing is within the corporate sector, even though everybody says, yeah, business isn't coming back, we are seeing signs of life in corporate. It is not going to be the Fortune 500 companies going to major markets, but a lot of the local corporate and the smaller corporate accounts, we're starting to see it's not heavy, but it's the beginnings. It's still the summer also. So as Amanda said, when it comes to September, we're going to really see what happens when kids are back in school and summer vacation is over. But for me, seeing some of that corporate business come back, I know the group business, we started to see a little bit of it, but it's more the Smurf or the social market, the weekend business, the lacrosse teams or soccer teams. It's not what it was before for sure, but we're seeing some of that. So again, from an AAHOA point of view, these are really good signs because the sectors that we're seeing, upper, mid-scale, and upscale hotels have the best picture from, this question of the horse race between the direct business coming through loyalty member rates and OTA. Upper, mid-scale, and upscale hotels are having the best an advantage to the loyalty member rate business as opposed to the OTA business. And that's really encouraging.
Okay, Amanda, I see you shaking your head, so.
Just to add, the upper mid-scale economy and mid-scale segments, we're seeing they're filling over half of their rooms. So they're running above 50% occupancy in those segments. The upper upscale chain scale segment is still 2/3 empty. So those are the big box hotels that are used to, the business transient and the group meetings. Today, they're still empty, pretty empty, 2/3 empty. And it will be into the fall before we see if that changes. But right now, in markets that we're not usually talking about, right? So we're talking about markets that usually aren't at the top of the list, but in some markets, hotel owners are doing better this year than they were doing this time last year. So it's a very different story depending on what market you're sitting in, what your business looks like. But if you're in that limited service segment in certain markets right now, you're having a better year than you did last year.
Can you give some examples of certain markets?
Yeah, so, the states right now, overall the states with the highest occupancy are Wyoming, Idaho, South Dakota, Montana. Those are states we would never be talking about. But the best performing occupancy market for the week that ended August 1st was McAllen, Brownsville, Texas. So you're looking at smaller destination markets where people are going to the beach. You've got Colorado Springs, the second highest occupancy market. So, people are going to destinations and there is some pent-up demand. Those markets are doing really well with very high occupancies. It's just not something the ones that would normally be the top of the list.
It's not the big cities, sure.
It's not New York City or LA or any of those.
No, Pensacola, Panama City. these are showing up on our top RevPAR, net of costs on our top occupancies. A lot of small vacation destination with a lot of drive-to market.
A lot of the drive-tos, markets. Sure.
Right.
Jamie, do you want to jump in on this at all?
Yeah, only and there's not a lot to add there, but and for the other markets, leisure-oriented or business-oriented, we're still looking for sort of airline employments to tick back up. and a lot of markets rely on the air traffic to come in. It's still down 72%, which is very low, though has picked up a bit in the past couple weeks. And Cindy, looking at how it compares with your data, and it looks like it aligns really close to the GDS bookings. So corporate travelers and traveling through the air and booking through GDS, both down 75, 80%. And as we go into the fall travel season, as you guys have said, and if those don't start to pick back up, and we're probably going to see and lower occupancies going forward, or at least a dip back down as sort of the demand mix changes.
And I think, Jamie, that's such a good point on the airlift. Like that could be a real barrier to some recovery for us also, because there's limited capacity. Airlines have had to cut routes. So that is something that we're watching as a barrier to our recovery in the fall for travel because of the limited airlift.
But
Right.
again,
The passengers going through TSA ticked back up in the last week after 2 weeks of a drop in TSA passenger throughput. So we were happy to see an uptick in those numbers.
Right, Cindy?
But the drive to corporate and drive to group, which are the two big areas that are the big gaps in the major markets, there's still drive to business that will be coming. And, that's going to be, I'm sure we'll see more and more of that. I mean, the corporate business in the lowest part of the downturn was down 73% in terms of occupancy share. As of our latest July 31st, it's down 52%. It sounds horrible, but compared to 73, 52 sounds a lot better. And a lot of that is smaller corporate kind of activity. So we know that the big corporate accounts are not letting their teams travel. We know that's going to be off. And the big groups, we know that's going to be off until municipal and county and state restrictions enable groups of bigger than 50. So, as far as filling in other business, there's going to be a lot more competition between the upper upscale hotels and the, sort of down market hotels, because they're going after a lot of the same travelers. The pie just is shrunk for a little while. It's not that they can just replace it with something else. It's the pie got smaller. And until that other business fills in, the pie isn't going to grow back to where it was.
So Cindy, let's talk a little bit more about booking channels and how they're faring. You want to comment on that?
Sure. So, the biggest question everybody has is, are the OTAs going to become this dominant force like they had been? And I have to say that the introduction of these loyalty programs 3.5 years ago, nobody knew how much traction it would get or how sustainable it would be. But an interesting point that I have observed is that the loyalty programs are not just point driven. They have benefits like mobile apps, and the mobile apps have things like mobile check-in and keyless entry and choose your own room. And when travelers want to use those contactless apps in order to, improve their experience and feel safer, they're more likely to book direct. So, that it's going to impose some strain on what the OTAs had in past recoveries as a dominant position. As Jamie referred to, the GDS business is definitely very far off because they depend so heavily on the larger corporate accounts. So I think that brand.com, which is, the core of the direct business, and the voice channels come down as badly as we expected. People are calling and they want to make sure that the hotel is okay. They have more questions. So voice and brand.com, the biggest channel that we've seen in terms of growth is property direct, because people are more likely to just, drive up, call, go to the properties directly. So we have had less loss there. But as far as the OTAs, they're definitely coming back, and they definitely have some strength, but they're getting a run for their money with the direct channels because of the loyalty programs and because of these apps also.
Okay. So hotel business recently, our current issue actually, our cover story was what's the deal? So what about transactions? What do you see from the lender, broker, developer, advisory communities? And what advice do
Yeah,
you have?
so and I'll jump in there with us being a brokerage firm. So, and latest numbers from RCA and transaction volumes were down 91% in Q2. So total volume was just 600 million. Uh, but it does look like it's turning. So I sit on daily calls with our brokerage teams. They're as busy as they've been in a long time, and taking huge numbers of BOVs. Our debt team is tracking about 80 lenders that are willing to lend on hotel product, which is very good compared to past recessions, and
Mm-hmm.
seeing a large amount of bids from all lender types, bank, life companies, debt funds, on making deals happen. In terms of and value impairment, our valuation team, that business has picked up substantially, and they're doing something neat where they're tracking properties, and how they're valuing today compared to how they valued pre-COVID. On average, values are down about 25%. And that's closer to like 30% for full service, and as little as 10 to 20, 15 to 20% for select and limited service hotels. So maybe not as much as maybe the REIT prices are showing that, and REIT stocks are down 50%. But as we're looking at it, both on the valuation side and actual transactions, and anywhere from 15 to 30% down.
Okay. So
I mean,
I think as you,
the
go
name of
ahead,
the game
Cindy.
now is also, I mean, in the lending community, as everyone well knows, 95% of the hotels in the U.S. are have some sort of debt, and everyone is now trying to restructure that debt and deal with this period of time that is unknown, that we have to make it through before the business comes back. The good news is the business will come back. The
Right.
hotel industry will come back, and we know that it's not like retail or other industries that may not, may remain in a virtual mode. So that's the good part. But the question is, between now and then, how does everyone get through? And debt restructuring is a big deal. And lenders, and 30% of it is being done through CMBS, which is a complex web of, people who are trying to figure out how that can be dealt with in this interim period. So it's a difficult period, but I think that the debt restructuring activity, which we support with data, is it looks like encouraging in a way that there's openness to do the restructuring, and there's many hotels that are finding a path forward through that.
Okay. Amanda?
I just think the real question is, I completely agree. The real question is, how long is this interim period, right? Like, yes, the business is coming back, and we all know that, and we're all confident in travel, and travel will come back around the world. But how long does that interim period last? And that's really what the owners and trying to refinance debt, that's really the question that we have to answer, is how long does this last before we get back to pre-COVID levels. And I think it's going to be a little longer than what any of us would like, obviously, but it will put us in some situations where we do have some distressed assets that come to the market, and we'll see some transaction activity around those distressed assets.
Right.
Because of the longer period before we get to pre-COVID levels.
Jamie?
And I would just like to note, and we are very much involved with owners out there trying to get enacted the HOPE Act to really help hotel owners provide liquidity and get cash on their balance sheets. So that's legislation's out there, and suggest everyone look it up and be involved in that front.
Okay. We only have a little bit of time left. So to end on a positive note, because it's always good to do that, with all the talk of doom and gloom out there, is there some silver lining or some positive issues for owners to take note of right now to get them through? I'm going to start with Amanda.
Yes, I mean, as I said earlier, there are some hotels in some markets that are doing better right now than they were last year. So there are positive stories out there. You know, we do a lot of custom forecasting at a comp set level for clients, and we see some hotels in the luxury segment that are running, you know, a much higher ADR today than they were last year because they have a different mix of business today than they did last year. And yes, occupancies are down, but their average daily rates actually up compared and significantly up compared to last year. So there are positive stories out there happening today. And I think as you look forward to the outlook for the industry and how long does this period last before we get back to where we were, you know, we anticipate that demand's going to recover faster than average daily rate. But by 2023, we'll be back to our 2019 levels of demand. It may take us a little longer on the rate side, but demand will come back sooner.
Okay, Cindy.
So besides for the good news that we know the hotel industry will come back, we also see rates coming back, and in some markets are reasonably strong. The comment I made earlier about the brand-based loyalty member rate kind of programs, those rates if you net them out with booking costs and you look at just the net rate, what we call COPE average rate, there's 15 to 20% premium on that direct business. That is awesome and wonderful because that's flow through cash. You know, that's goes straight to the bottom line. So if the business that's coming in this interim period is coming in at a higher rate and a more profitable kind of business, that's really terrific. So, you know, when I talk to owners all the time and it's like, what can we do? Instead of just passively thinking we take whatever business we can, if you're affiliated with a brand, a lot of the programs they're doing will yield more profitable business. And it's worth investing in those because you're investing in the OTAs just by paying them those commissions. So to think that you're not paying something to them, it's coming in the form of commission or the programs that they're offering. You don't have to do every one of those. A lot of the travelers we've determined through surveys and other kind of research are channel agnostic. So to get them to come through the direct channels, and we've seen there's already an advantage in a number of the chain scales for this direct business, that would be a big plus. It would improve profitability and it would also improve the average rates. So, you know, we're seeing the rates coming back. Hopefully everyone won't be discounting as they have in the past. Right now, most of the discounting is around promotional rates, which is okay because the base rates can still remain. So I see some very positive signs in the fact that a lot of the recovery is coming directly, and it never did that in the past. It always came through third parties.
Okay, so Jamie, since I started here, you get the last word.
Yeah, and it really follows in on what Cindy said. So we've been tracking GOP margins throughout the pandemic, and those that we're seeing today are actually better than we've seen at past periods of past recessions, past times of really low occupancy. So, and hotel owners and operators, managers have really rolled up their sleeves. They've been very proficient at controlling costs. The brands have been working with them, being lenient in terms of service and amenity requirements. So, and we've learned that fixed costs aren't really all that fixed. So, and it does provide some green shoots going forward that the industry is going to get through this, and demand's going to come back, and we're going to return to profitability. And the industry will largely make it through as a group.
Sounds good. Thank you all for your time, Cindy, Amanda, and Jamie. I totally appreciate it. I know that the audience does too. And everyone stay safe and healthy and hopeful. Thank you.
Thank you.
Thank you.